How can you get a lower interest rate in this high interest rate environment? We're going to talk about that next. Hey there, my name is Ryan Skaggs, and this is the Mortgage Minute. This channel is dedicated to everything mortgage, real estate, and interest rates. And we're going to start with those interest rates. The average 30-year fixed right behind me, according to Freddie Mac, is 7.18%. Now, this is essentially at a 22-year high. We're down just a little bit from last week, but we've hit kind of that 20-plus year high. Now, where do we see interest rates going? I've done some videos on that before, but what I want to really talk about today is how to get a lower rate or something to think about as you're out there potentially buying a home in 2023 in these higher interest rate environment than what we've seen in the past few years. And one of those options is what you've likely heard of, an ARM, an adjustable rate mortgage. Now, all of the info I'm going to link below, including the link to Freddie Mac, so you can see that weekly survey. I'll put that below, and then everything we're going to talk about on the adjustable rate mortgage side as well, including some of the charts, I will link down below in the description. So if you made it this far, I'd be forever grateful for the subscribe. So click that like button, click subscribe, and then click that bell icon to be notified, putting out weekly videos on the channel. Now, let's dive into the ARM scenario, or adjustable rate mortgage. So first and foremost, I'm not going to go into every detail of the ARM, but I do want you to kind of better understand the interest rate difference between what an adjustable rate and, say, a standard 30-year fixed is. So right now, the average, looking at kind of, and I'll put this up on the screen here so you can kind of see 30-year fixed versus a 10-year ARM versus a 7-year ARM versus a 5-year ARM. So one of the things you absolutely need to understand when you look at kind of the bottom going up is that why on earth would the 5-year ARM be higher than the 7 or 10? So that's an interesting question. We are in 2023, and right now our short-term lending rates are as high, if not higher, than some of our mid to long-term lending rates. And there's a whole host of reasons that we can talk about. So I'd love to hear your comments below. Why do you think that's the case? Now, you can see that 5-year ARM just doesn't have a lot of delta or difference between that 30-year fix or the 7 or 10-year, right? So let me give you a few stats here. In 2022, the difference between the 30-year fixed and the 7-year ARM. So in 2022, 5.55 was our average 30-year fixed end of August. I'm just going to use end of August since that's when we're shooting this video. End of August, 5.55. Average 7-year ARM was 4.36. So 1.2 basically in terms of the difference. That is a big difference. 1.2, 1% or more is a huge difference for that difference between 30-year fixed and 7-year ARM in this case. Going back to 21, 2.87 on our 30, 2.42. So in this case, we're getting 30 to 40 basis points. Now, in 2020, 2.91 versus 2.91, they're exactly even. That's when the 30-year fix was really getting bought like crazy. This was kind of mid-COVID, right in the heart of it, and the government had stepped in and started buying 30-year fixed, and we're kind of artificially pushing our 30-year fixed and Fannie Mae, Freddie Mac ones down by buying those. So in that year, it was exactly even. There would have been no benefit to necessarily do a mid to short-term ARM. Going back to 2019, 3.58 versus 3.31. So again, about a 0.5%. Right now, the average between, say, a midterm ARM, a 7 or 10-year ARM, and a 30-year fixed is only 0.25 to 0.5%. But again, in this higher interest rate environment, that 0.25 to 0.5% could be the difference. Prices continue to increase. We continue to see low inventory. We continue to see buyers coming into the market and purchasing even in this higher interest rate environment, because my assumption is they believe kind of what I believe, is that prices are going up. We have such low inventory that we're going to likely kind of stabilize, but we're not going down necessarily. So would love to hear your thoughts on where we're going to go in terms of housing prices. But at that point, even if they lock in a interest rate with a 7 or an 8 or whatever the heck it has in front of it, in future years, if we see a lower interest rate environment, they can just refinance down to whatever that new lower rate is, but they still own the home. And they got it for hopefully a price that is then appreciating over time, right? So now these adjustable rate mortgages, you definitely want to better understand when is it going to adjust, how many years is it fixed, and when is it going to adjust, what is the maximum it could adjust, meaning like, say you do a 7-year ARM, it's locked in for 7 years. What happens in year 8? You need to be asking your lender, asking your loan officer, ask your mortgage loan originator these questions. Now, I've done some videos about what is an ARM, and I'll link those above to kind of give you more of a understanding of the detail of an adjustable rate mortgage. And then the last part that I'd be asking is, what is it based on? What is the benchmark that this rate adjustment would be based on? And then look at a chart to see, is it going like crazy? It could be on Treasury, an old one that we used to use as LIBOR. Now a lot of them are SOFR. It's called SOFR versus LIBOR. There's treasuries. There's all kinds of different things it could be based on, right? And that benchmark. So go back and look at the chart. Ask the question, look at the chart, and if it's huge fluctuations, that means when the time comes that your adjustable rate mortgage could be adjusting, then if you're on one of those big swings, that might not be good, right? So you want to kind of do your homework, better understand it. For those that are purchasing in that, say, under 600,000, which is a majority of America, there's just not a lot of savings. There is a little bit, so it's something to consider, but there's just not a lot of savings out there for these adjustable rate mortgages. Where you're really going to see it is when you get into jumbo financing. I'm on the north side of Chicago. We've got a bunch of suburbs that have, some significant high price points, compared to the overall average. And these jumbo ARMs are very much a thing every single day, but there just doesn't have the difference that we used to see it. So this is how to save a little bit in terms of your interest rate. I'd love to hear where housing prices going. What do you think in terms of interest rates moving forward? So put those comments below. Again, if you've made it this far, click that subscribe button. I'd be forever grateful. Stay safe. Check out those links below, and we'll see each other again very, very soon.